Hello everyone, welcome back. What happened in the silver market over the last 24 hours is not something you see in a normal commodity cycle. This wasn't an algorithmic glitch, it wasn't random volatility, it wasn't a speculative blow-off. This was something entirely different. Silver dropped sharply to $62.70 and then, within hours, exploded back to $70 with one of the most aggressive upside reversals we'd seen in years. Moves like this don't happen without structural pressure under the surface. This kind of rebound doesn't happen unless buyers are panicked, shorts are trapped, and physical supply is stretched to its limits. Today's update isn't hype. It's an attempt to walk you step by step through the exact forces behind this insane move. Why the dip was instantly bought, and why the spike back to $70 signals something deeper than volatility. Because behind this price action is a story the mainstream still isn't talking about. Silver's physical backing is shrinking at a pace that is absolutely unsustainable. And yesterday's bounce shows the market just realized it. This video is for educational purposes only, not financial advice. With that said, let's break down what really happened. Section 1, the dip. Why silver fell to $62.70. Silver's sharp drop caught a lot of traders off guard. From the outside, it looked like a typical high-level rejection. But here's what actually happened. 1. Short-term profit-taking hit the market. After silver's recent sprint above $65, some leveraged traders closed positions. That created a small vacuum. 2. Algo-driven selling amplified the weakness. Most trading platforms are built to respond to rapid momentum shifts. When silver dipped below $64, algorithmic triggers fired, compounding the downward move. 3. Thin liquidity during off hours exaggerated the fall. The dip happened during a low liquidity window, where even moderate selling pushes price harder than usual. 4. Futures traders interpreted the dip as a relief break, but only for about 2 hours, because what happened next made it clear this wasn't a trend reversal. It was a setup, one that set off the biggest FOMO wave we've seen in months. Section 2, the snapback. Why silver exploded back to $70? Silver's rebound wasn't driven by speculation. It was driven by fear of missing out, but not from retail. It was institutional. The rebound occurred because the large players who have been accumulating quietly saw something that forced their hand. The physical market flashed a warning sign, a very big one. Multiple vault reports showed accelerated declines in available silver, not slow drains, but massive, aggressive withdrawals in a very short time frame. It was the kind of data point that can flip a market instantly. And when that data hit, the people who must secure physical supply, the refiners, the industrial buyers, the ETFs, the bullion desks, they stepped in at the exact same moment. The result? Silver didn't bounce. It catapulted. Section 3. The real driver. Physical inventory is vanishing. To understand why yesterday's rebound was so violent, you have to look at the one number institutions obsess over, registered inventory. This is the silver backing futures contracts, the metal that can actually be delivered, and the trend is stunning. Over the past week, inventory dropped at a rate we haven't seen in over a decade. To visualize it, normal daily outflow across 200,000 ounces. This week's daily pace draws 30 million ounces. That's roughly 100x faster than normal. If this pattern continues, even at half the speed, registered ounces could hit critically low levels within weeks. The system is showing signs of a delivery bottleneck, the kind that forces shorts to panic and buy back contracts aggressively. Once that panic starts, every dip becomes an automatic buy, exactly what we saw at $62.70. Section 4, the ETF surge. Big money is moving. While retail investors usually get the blame or the credit, this current rally isn't retail-driven. The big tell? ETF holdings just surged at one of the fastest weekly paces in years. One large silver ETF added hundreds of tons in days, its largest inflow since early 2021. That kind of movement is not small money. Institutions are positioning hard. When ETFs buy like this, two things happen. They pull physical metal off the market. They drain liquidity from the futures side as well, which means demand gets pressure from both ends. This is how squeezes begin. And it explains why yesterday's dip was erased instantly. Big money is not waiting anymore. Section 5, the options. Market screamed, buy now. Another clue that yesterday's move was structural? The options market. Over the last 72 hours, call buying at the $70, $75, and even $80 strike levels exploded. These weren't small buys. These were institutional-sized positions. The expirations? January and February, meaning buyers expect movement soon. This is classic positioning for a squeeze. Not in 6 months, in 6 weeks. When big capital buys calls like this, they're not speculating. They're front-running something. And that something became clear when we looked at who else moved. Section 6. The institutional shift. A major bank just flipped long. One of the largest metals desks in the world recently shifted from net short to net long silver futures. They haven't done that in years. This is not a minor change. This is a signal. And when bullion banks reposition, they don't do it lightly. They do it because they see accelerating physical demand, insufficient supply, rising lease rates, rising borrowing costs, and potential delivery stress. All of that is happening right now. Yesterday's price action showed the market reacting to that reality. A dip in the face of structural shortage. Institutions pounced. This is not randomness. This is preparation. Section 7. The 4 indicators that explain everything. Now let's discuss the 4 indicators I personally track every day that tell me exactly what kind of market we're entering. These aren't guesses. These are real-world verifiable signals. Indicator number 1. Registered inventory. Current estimated level. For 19 million ounces. Thresholds to watch. Below 15 million. Severe shortage signal. Below 10 million. Full-blown delivery crisis. Below 20 million. Tight market persists. Right now, we are barely above the tight zone. Any further stress puts shorts in a dangerous position. This is why the dip was instantly bought. Indicator number 2. Lease rates. Current estimated 1-month lease rate. 138% annualized. When the cost of borrowing physical spikes, it means vaults are dry. Refiners are desperate. Industrial users can't find supply shorts are willing to pay almost anything to borrow ounces. Historic stress threshold. 50% plus lease rates. This level has only appeared a few times in 20 years, and each time it preceded massive rallies. We are dangerously close. Indicator number 3. Backwardation spread. Spot versus 3-month futures. A spread of 0.40. In a normal market, futures should be above spot, but in backwardation, spot trades higher, meaning buyers need metal right now. If spot stays above futures for 5+ days, it typically signals the start of an explosive move. We're nearing that threshold. Indicator number 4, Shanghai premiums. Currently around 0.2%. When Chinese buyers bid above Western spot prices, it means the global market is struggling to distribute supply. Stress threshold, 2% plus sustained premiums. We briefly saw 4 or 5% recently. That was a major warning. If premiums rise again, it means Western vaults are not the only ones feeling strain. Section 8, when all 4 indicators align. This is where things get serious. The last 2 times all 4 of these indicators aligned, silver rallied 40% plus within 6 months. Not speculation, historical fact. If we see inventory under 15M lease rates above 50%, sustained backwardation, Shanghai premiums, plus 2%. That is the trigger for a runaway squeeze. Yesterday's dip to spike move looks like the early stage of alignment. Section 9. 3 possible scenarios from here. Based on historical commodities behavior, current inventory data, and monetary policy, I see 3 possible outcomes. Scenario 1, the parabolic squeeze. Probability, 30%. Target, $85-$100 by summer 2026. Triggers, inventory drops under 12 Amendment lease rates, blow past 50%. A major industrial player tries to secure long-term supply. Backwardation stretches out to 90 days. If this happens, silver could behave like palladium in 2020 or nickel in 2022. Vertical moves, liquidation waves, and extreme volatility. Risk, rule changes at the exchange level. But even those tend to spike spot prices. Scenario 2, the measured rally. Probability, 50%. Target, $70-$75 short term. Then range, $65-$80 through 2026. This is the most likely outcome if we see inventory stabilize around 20 to 30 metaamperes lease rates, pull back below 30%. Backwardation stays shallow, silver slowly grinds higher with big swings. This is the FOMO but orderly scenario. Scenario 3, the correction reset. Probability, 1,020%. Target, $52-$58 before building higher. Triggers, a temporary collapse in industrial demand. Chinese premiums turning negative Fed, turning unexpectedly hawkish inventory suddenly rising above 48 million. This scenario requires multiple bearish catalysts. Unlikely, but not impossible. Section 10, the bigger picture. Industrial demand is exploding. Silver's price isn't just about investors. The real story is industrial demand. In 2025, the 2026 demand looks unlike anything we've seen. Solar, 230 plus ounces. These numbers keep climbing every year. EVs, 70 M plus ounces. More EVs, more silver. AI data centers, 40 M plus ounces. Servers and networking equipment use silver-heavy components. Other tech plus medical demand constantly rising. These industries cannot substitute away easily. They need silver regardless of price. That is why dips like yesterday get erased instantly. Section 11. The Fed factor. A key part of this story. The Federal Reserve's December pivot was not a small adjustment. It was a regime change. Rate cuts and renewed liquidity programs pushed real yields into negative territory. Silver thrives in environments where real yields, zero. Liquidity rises. The dollar weakens investors, distrust paper assets. All of that is happening right now. The Fed set the stage. Physical scarcity lit the fuse. Yesterday's price action was the spark. Section 12. The gold-silver ratio says we are early current ratio. From 68.1. In silver bull markets, this ratio collapses to 50, to 40, to 30, sometimes even to 20. If gold stays at $4,000, a 40.1 ratio implies $100 silver. A 30.1 ratio implies 133 silver. We are nowhere near those levels yet, meaning silver's run is only beginning. Conclusion. The FOMO move was not random. Let's wrap this up. Silver dropping to $62.70 and blasting straight back to $70 was not volatility. It was a message that inventory is tight, industrial demand is relentless, ETFs are buying institutions, are repositioning options, traders are loading up shorts, are nervous, physical markets are stressed. The Fed has weakened the dollar. This was a FOMO move, but it wasn't retail FOMO, it was institutional FOMO, and that is far more powerful. Stackers, we are entering a historic phase for the silver market. I'll keep tracking all four indicators, and the moment we cross what I consider critical thresholds, I will release an emergency update. Make sure you're subscribed with notifications on. Drop a comment. Which indicator do you think breaks first? I rate every single one. See you in the next breakdown.